Welcome to the debate. Today, we are taking a hard look at a concept that has become the absolute holy grail of modern personal finance. It is the promise of, making money while you sleep, the key to the FIRE movement and the dream of escaping the 9 to 5. We are talking about passive income. In the strictest accounting sense, we're defining this as unearned income acquired with little to no active labor to earn or maintain it.
But as we dig into the reality behind that definition, it becomes immediately clear that little to no labor is a phrase doing an incredible amount of heavy lifting. The central question we need to wrestle with today is stark, and it really cuts to the bone of our economic system. Is passive income a legitimate, necessary mechanism for financial independence and capital growth, or, as I intend to argue, is it primarily a vehicle for tax avoidance and wealth extraction that structurally disadvantages anyone who earns a living through a paycheck?
It is a fair, if somewhat cynical question. And to find the answer, we are going to explore how this is treated globally, looking at tax classifications in the US, China, Russia, and Kazakhstan, and we'll look at the economic theories surrounding unearned income. I represent the position that passive income is a vital financial instrument. It is the engine of stability that rewards risk and capital accumulation. Without it, there is no retirement, only indefinite labor.
And I will be taking the position that the term passive is, frankly, often a misnomer used to disguise active labor for tax purposes. Furthermore, I'll argue that structurally, this income category functions as a loophole allowing high-income groups to pay lower tax rates than the working class, echoing J. Ed Hobson's concept of improperty.
All right, let's get right into the heart of the matter. When we talk about passive income, my perspective, the advocate's perspective, is rooted in the concept of financial independence. The ultimate goal for any prudent investor, and frankly for any rational worker, is to reach a point where you receive revenue regardless of your material activity on a given day. This isn't about laziness, it's about decoupling your survival from the hour-by-hour sale of your time.
I understand the allure. Financial independence is a very potent narrative. Who doesn't want to own their time? It resonates because, the alternative is grinding until you drop.
But it is more than just a narrative. It is a mathematical necessity for the life cycle of a human being. We physically cannot work forever. Look at the legitimate sources available to achieve this. We have deposits, where you keep a set amount in a bank account and interest accrues. We have certificates of deposit, or CDs, where a depositor agrees to hold a fixed amount for a fixed period. These aren't loopholes, they're contracts. And most importantly, we have the stock market. In fact, investing in a stock market index fund is noted in our material as the most popular form of passive income.
I'm not disputing that these vehicles exist or that they are useful tools for the individual. My issue isn't with the tools themselves, but with how they're framed and treated by the system.
Then consider the mechanics behind them. Well, this income is unearned in the sense of immediate labor, meaning, I didn't sweat for the dividend check I received this morning. It often requires a long period of prior work and accumulation to acquire the asset in the first place. You don't just wake up with a stock portfolio or a rental property. You work, you save, you forego consumption, and you take a risk. That risk, whether it's volatile stock prices or the locked-in nature of a CD, justifies the return. It distinguishes the income from simple labor compensation.
See, I come at this from a fundamentally different angle. You are describing the accumulation phase, the how to get there. I want to look at the extraction phase and the societal definitions involved. My perspective is that this system fosters structural inequality. First, let's just look at the passive label itself. It often masks what is actually leveraged income. Take writing an ebook or producing a video course. The source material explicitly classifies this as labor invested in a product that is sold indefinitely.
That falls under royalties or digital product income. It's a standard classification. Authors have lived this way for centuries.
But think about what that classification does. It takes substantial initial work, active labor, and lumps it into this passive dream. But my deeper concern is the economic critique regarding taxation. Generally speaking,
High-income groups have diversified sources of revenue. They are uniquely positioned to sort of hide active income as passive income to lower their tax bills.
That implies an intent to deceive rather than an intent to invest.
The effect is the same regardless of intent. When you have a system where unearned income is taxed more favorably than wages, you degrade the personal income tax into what critics call a wage tax, aimed squarely at the exploited middle-income working class. This brings me to J.A. Hobson. In the 1930s, he introduced the term improperty.
Improperty.
Improperty. He wasn't talking about owning a toothbrush or a car. He was describing ownership used specifically for extracting income from other individuals, like tenants paying rent, rather than creating new value. That is the dark side of your financial independence. It's not just money growing on trees, it's money being transferred from those who work to those who own.
That is a provocative historical reference, and I see the moral weight you are placing on it. But I think we need to ground this in the practical reality of how these activities are defined and regulated today. I mean, we can't just rely on 1930s theory to explain modern finance. This brings us to our first core area of debate, the reality of passivity versus material participation. You mentioned earlier that true passivity is rare.
I did, and I stand by it. Let's look at rental income, which is, often cited as the gold standard of passive income. The idea that you just buy a building and the money rolls in is, well, it's a fantasy. Rental income generally requires managerial and custodial duties, finding tenants, organizing repairs, dealing with complaints. Unless you outsource this to a leasing agent, you are working. You are a property manager, not a passive investor.
But that outsourcing is the key distinction. The moment I hire a manager, I've removed myself from the equation.
But wait, look at the U.S. definitions. The IRS is very specific here, and it actually supports my point that the line is blurry. A rental isn't even considered a rental activity, and thus automatic passive income if the average customer use is 7 days or less.
You're talking about the Airbnb rule.
Exactly. If you are running a short-term vacation rental where guests stay for a weekend, that is a trade or business. Or if the average use is 30 days or less and you provide significant personal services, like cleaning or meals, the law recognizes that this is active labor. Yet, thousands of people call themselves passive investors while running what is essentially an unlicensed hotel. They want the tax benefits of passivity while doing the work of a hotelier.
I see why you think that supports your argument, but let me give you a different perspective. Those definitions actually prove that the system works to separate the workers from the investors. The distinction is legally clear and valuable. If I am a silent partner in a business, a concept explicitly detailed in our material, I have no role in the company. My participation is limited to providing capital. I earn a percentage of gross profits purely for financing the venture. That is the definition of passive.
A silent partner is a specific edge case, usually reserved for the very wealthy who can afford to just dump money into a venture and walk away.
It's not an edge case, it's a foundational concept of capitalism. It's the basis of the entire stock market. When you buy a share of Apple, you are a silent partner. You provide capital, they provide the product. And regarding real estate, if I hire a leasing agent, I have legitimately converted active ownership into passive profit. The agent earns a wage, active income, and I earn the surplus if renters are willing to pay more than the cost of upkeep and taxes. And let's not forget portfolio income, dividends, interest, royalties. In those cases, the money itself is doing the work. The stockholder does no physical work for those dividends, the employees of the company do.
I'm sorry, but I just don't buy the phrasing that the money does the work. That is a euphemism for other people do the work and the capital owner takes the cut. Money is inanimate. It doesn't sweat. But let's move to where this distinction really hurts society. Taxation and economic fairness. This is where the rubber meets the road. If passive income is just a reward for risk, why is it so often taxed so much more gently than the labor that actually keeps society running?
I'm happy to discuss taxation because I believe the systems are more robust and fair than you give them credit for. They aren't designed to be punitive. They are designed to stimulate.
Are they? Let's look at the evidence from China. China currently adopts a proportional tax rate of 20% for passive and unearned income.
Meaning a flat tax.
Right. A flat 20% on interest, dividends, incidental income. Meanwhile, active labor is subject to a progressive marginal rate that goes up to 45%.
That is a significant spread, I grant you.
It's horizontally unfair. It fails to regulate the income distribution gap. You are literally taxing the sweat of a worker at more than double the rate of the capital gains of an investor. And it's not just China. In the US, portfolio income, capital gains, dividends, is often taxed at significantly lower rates than active wages. This incentivizes the wealthy to shift their income classification, not necessarily to be more productive, but to be more tax efficient. It tells the society that owning is twice as valuable as working.
That's an interesting point. Though I would frame it differently. You are looking at the revenue side, but you are ignoring the risk and loss side. These tax structures are complex systems designed to account for losses, not just revenue. If the system was purely a giveaway to the rich, you'd expect them to be able to write off everything. But take the U.S. passive activity loss rules. They are quite strict. Generally, taxpayers cannot use passive losses to offset active income.
Could you clarify that for our listeners? Meaning, if I lose money on my rental, I can't use that loss to lower the taxes on my salary?
Exactly. If you have a high salary as a doctor and you buy a rental property that loses $20,000 a year, you generally cannot use that $20,000 loss to reduce the tax bill on your doctor's salary. You can usually only offset other passive income. This prevents high-income wage earners from buying tax shelters just to wipe out their tax bill. The IRS walls off these activities, and frankly, not all jurisdictions are as lenient as you suggest regarding rates. Look at Russia.
Go on.
In Russia, income earned on sales of securities is taxed at 13% if sold for a profit. Non-residents paying on dividends from Russian companies pay 15%. If a stock loses value, you don't pay tax, but you also don't get a refund on your lost capital. The government takes a slice of the win. These structures incentivize investment in the economy. When you buy a bond, you are lending money to a municipality or a government.
I'm not convinced by that line of reasoning, because it assumes that the primary purpose of these tax breaks is economic stimulation rather than wealth preservation for the elite. You mentioned bonds. Let's talk about who actually owns these things. This brings us to the barrier to entry.
I think you'll find that bonds are one of the safest instruments available for anyone prioritizing stability.
But access is stratified. You keep talking about these tools, stocks, bonds, silent partnerships, as if they are universally accessible.
Before we get to stratification, let's just look at the mechanics of risk, because that explains the access point. Passive income instruments offer varying degrees of safety. You have bonds, government or municipal debts. They have a face value, a coupon rate, and a maturity date. They are, arguably, the safest financial instruments. They pay lower returns, but they are stable.
Stable, yes, but low yield. I mean, if you don't have a massive amount of capital to start with, a 3 or 4% return on a bond isn't changing your life. It barely keeps up with the cost of milk.
Contrasted with stocks. Stocks allow for wealth building through market capitalization growth and dividends. But they are volatile. Value stocks, for instance, have high financial leverage and face substantial uncertainty. The reason passive income is taxed differently or treated differently is because the investor is absorbing the shock of the market. Building a diversified portfolio of both stocks and bonds protects individuals against market shifts. It's a prudent strategy for survival, not just a loophole for the rich.
That's a compelling argument, but have you considered the actual data on who holds these assets? The material notes that about 20% of Americans receive passive income. That sounds like a lot, right? 1 in 5. Until you see that of those who receive any, most receive less than $5,000 per year.
$5,000 is not an insignificant amount of money for a household. That's a safety net. That's an emergency fund. That pays for the heating bill in winter.
It's helpful, sure, but it's not financial independence. It's not fire your boss money. It's pocket change compared to the improperty amassed by the wealthy. The real life-changing passive income is concentrated at the very top. And look at the other categories, digital products and royalty arrangements.
These are framed as accessible. Anyone can write an ebook, right? But legitimate royalties usually involve being a licensor or owning patents. These are legal barriers that exclude the general wage earner. You need to own the intellectual property to extract the rent.
I acknowledge the barrier to entry for IP is high. However, the barrier to entry for a high-yield savings account or certificate of deposit is effectively zero. Anyone can start.
But the return on a savings account doesn't allow you to retire early. It barely beats inflation. To play the game you are describing, the game where passive income replaces labor, you need significant capital.
It offers security. And let's look at Kazakhstan for a moment to see how policy attempts to bridge this gap. In Kazakhstan, dividends are generally taxed at 5%, which is very low. But there are specific exclusions. Dividends on securities included in the official list of stock exchanges operating in Kazakhstan are excluded from taxable passive income entirely. The same goes for capital gains on those securities.
So another tax break for stock owners. That sounds like it reinforces my point.
Or, if you look at it differently, it's an incentive for regular citizens to participate in the local economy. By incentivizing listing on the local exchange, they are encouraging transparency and allowing anyone who can buy a share to participate in the corporate growth of the nation. It effectively democratizes the improperty you are so concerned about.
Democratizes it for those who have surplus capital to invest. We cannot escape the fact that passive income requires capital. If you are living paycheck to paycheck, you cannot participate in this system.
That is true, but that is an argument for increasing wages, not for dismantling the mechanism of investment. If we destroy the incentive to save and invest, which is what passive income represents, we destroy the capital base of the economy. If I can't earn a return on my savings, I might as well spend it all today.
Or we simply tax it fairly. When we look at Europe, the situation is even more complicated. The European Commission doesn't even have a strict definition of passive income. The OECD Common Reporting Standard lists dividends, interest, rents, and royalties, but leaves it to jurisdictions to define. This lack of standardization allows capital to flow to where it is treated best, tax havens, further disconnecting reward from labor.
The lack of standardization also reflects the complexity of the asset classes. You can't treat a net income swap, a contract between two parties to exchange cash flows, the same way you treat a grandmother renting out a room.
Ah, the roommate defense. The source material does mention that non-professional rental agreements, like renting a roommate, are a source for that 20% of Americans I mentioned. But let's be honest, that is not the passive income driving inequality. It's the large-scale portfolio income.
But they are governed by the same principles. The IRS classifies income into active, passive, and portfolio. While some analysts consider portfolio income, dividends, interest, as passive, the IRS generally distinguishes it. They only define passive activities as rental activity or trade or business activities where you don't materially participate. This nuance matters. It means the government is trying to differentiate between the rent seeker and the market investor.
I maintain that the distinction is often without a difference in terms of societal outcome. Whether you call it portfolio income or passive activity, the result is money entering a bank account without a corresponding hour of labor logged on that day. And when that income is taxed at 20% while labor is taxed at 45%, as in China, or given preferential capital gains treatment in the US, you are sending a signal. We value capital more than we value work.
And I would argue the signal is, we value the risk of capital. If I buy a bond, I might be repaid or the municipality might default. If I buy a stock, the company might go bankrupt. If I start a business as a silent partner, I might lose my entire investment. The worker risks their time, yes, and that should be compensated. But the investor risks the accumulated fruit of their past labor. If we remove the reward, the passive income, we remove the incentive to facilitate that economic activity.
But is the reward proportionate to the risk? Or is it inflated by tax policy? That is the question. The worker risks their health, their time, and often their sanity, yet we tax them at the highest rates.
I think we have reached the point of fundamental philosophical divergence, which is exactly where we want to be.
Indeed. To summarize my position, while the concept of passive income is sold as a dream of freedom, the mechanics reveal a system of impropriety. It allows the wealthy to bypass the higher tax burdens placed on labor. Whether through the guise of rental activities that are actually businesses or portfolio income that enjoys low tax rates, it structures the economy to favor those who own over those who do. It is a game where the entry fee is capital, and if you don't have it, you're merely a spectator.
And to summarize the advocate's view, passive income is not a loophole. It is the result of accumulated labor and necessary risk-taking. It provides a path to retirement and financial independence that differs fundamentally from wage labor because it provides the capital that businesses and governments need to function. From the safety of bonds to the volatility of the stock market, these instruments are tools for stability, not just extraction. It is the only way to eventually stop selling your time.
We can agree at least that the line between active and passive is much blurrier than the influencers would have us believe. It relies heavily on specific tax codes, whether you are dealing with the strict buckets of the US IRS or the proportional rates of China.
Absolutely. And for our listeners, the takeaway suggests you should examine your own income sources. Are you building leverage, labor invested once that pays out indefinitely? Or are you simply trading time for money?
And consider the tax implications of that leverage. Understanding the game is the first step to critiquing it or winning it. Thank you for listening to The Debate.
Until next time.